Next up, Nick DeVos needs very little introduction from Centaur Asset Management. Nick, thank you so much for your time.
Cheers. Thanks, Eugene. Good morning, everyone. Great to be here in Durban with you. Always feels like you're landing in Mauritius when you get to the airport here. It's like a heat wave. So I'm going to be discussing local equity. A lot of what I'm going to go through has been touched on by the previous presenters. But let's get into it. Just a business update very quickly. Centaur was founded in 2000. End of this month, the business is going to be 25 years old. We've got around 12 billion in AUM. 6.5 billion of that is in SA equities for some context. And then the investment team, we've got 7 members in the team currently. If you've been following Centaur, for a number of years, this is the biggest that the investment team has really ever been. So the SA equity fund that we launched, last year was a very good year, 10% outperformance. And then year to date, you'll see that benchmark line, the grey line that's been creeping up and ahead, and it's a lot of what the other presenters have been talking about. So really what's been driving the benchmark returns. It's a bit of a complicated picture here, but it's very simple if you just look at the grey shaded area. So essentially that's just showing you, other than the 11 shares above the grey shaded area, that's what SA Inc. shares have done. On essentially a year-to-date basis. So almost no returns from the broader market. It has been very concentrated. It hasn't been more concentrated than it has been in the past. It's just that it's been very concentrated in specific kind of factors. So gold and the PGM shares have done exceptionally well. But it's been broad across a number of shares. If you look at other year zones, are usually all in Naspers or Prosus or in a few of the mining names. But 11 shares is actually quite broad for the JSE if you go look back at history. So precious metals have been the only game in town. At Centaur, the only one that we've really had exposure to is Valterra. We recently upweighted that position quite a bit in the placement that they had. The SA equity fund sitting with just under 6% in Valterra at the moment. But other than that, of this list, the only shares here that we would really own through the cycle is Naspers and Prosus. And I can go through specific reasons through all the various businesses here as to why. Just in terms of our outlook, so I've just listed a couple positives and a couple negatives here. So far, I think probably the most positive, but it's not enough, is that we've had 125 basis points of rate cuts since the peak by the Reserve Bank. On the right-hand side, you'll see there, previous presenters mentioned, interest rates are still way too high. We think the Reserve Bank is being more than overly conservative. They fixated with this 3% inflation target, and they're keeping rates high. And admittedly, they admit to strangling the economy to some extent to bring the inflation rate down. We've even actually written a letter to Treasury about it. Then Bidvest, this was a statement in their result that I've just taken out. Transnet, private sector rail concessions, an extremely positive occurrence for overall supply chain in South Africa. A few years ago, the mineral councils came out and said if we can just fix things at Transnet, that should lead to about 2% odd additional GDP growth in South Africa per annum. I just want to caution, I think that fixing Transnet is going to take a bit longer than what all these positive headlines are. Maybe it's a 2-3 year kind of a process before we actually materially see volumes actually picking up, but it is a move in the right direction, getting private operators onto the rail lines. Another positive that's coming out, and it's mainly Chinese vehicles, but passenger vehicles year to date up 21%. Is a green shoot. The base is a bit low, but positive nonetheless. And then precious metals are improving South Africa's terms of trade. I saw a number earlier this week. There's round about current prices and prices continue going up, there's probably about 35-40 billion rand additional tax revenue that we'll collect over the coming 12 months because of that move. No negatives. I don't need to tell all of you about weak municipalities that are undermining growth. ANC succession uncertainty, who's going to replace Cyril. There were rumors at a stage that Patrice Motsepe might take up the reins there, but at the recent Rainbow Minerals, he seems to have dismissed that. And then, there's a lot of US tariff uncertainty. I don't think that's all doom and gloom, the tariff uncertainty or tariffs on SA. This is this concept of invisible hand. If we don't export to the US, products do tend to find different markets. So our expectation is for 1 to 2% GDP growth this year. Looks like it will probably come in below 1% next year because of this precious metal boom that we're seeing. I've seen numbers of 1.7% for growth next year, and if we can get closer to that 2% mark, I think that's when things will really perform. But the real silver bullet is if the Reserve Bank cuts rates way more aggressively than what they've done. And our base case remains for SA equities, so SA Inc. shares, to do around about 15% per annum over the coming 3 years from here. Banks, we think they're offering exceptional value. This is its first rand's earnings yield versus the SA 10-year government bond. So that highlighted kind of red circle right at the bottom, that shows you that First Rand actually used to trade at a premium in terms of its yield versus SA government bonds. And why it trades at a premium is because you typically get earnings growth from banks. Versus investing in a bond, you get the yield, but you don't get any growth. Now, First Rand's trading at a discount, which doesn't really make a lot of sense. So we think not only First Rand, but banks in general are offering exceptional value. Loan growth is improving. Year to date, you've got about 5.5% in loan growth. The corporates are borrowing more. That's probably around 8%. And the retail market is a bit slower and generally lags. I think it's about 2-3% odd. Credit costs are improving. And, just by way of example, First Rand, we think you're getting around, call it 8%, 9% earnings growth over the next couple. You get around a 7% dividend yield. Add a re-rating to that, and it's quite easy to see a 20% return per annum coming from First Rand. Then just a few quick themes. Absent any growth in South Africa, where we are invested, and we think there's a lot of opportunity. So the SA private school market, we think is still very attractive. You saw Yanni making the offer for Kiro. Kiro has been struggling in the space, but the example I'm going to be giving you is Advotech. So this example here is just showing that South Africa's private school enrollment's 5.5% versus the average OECD country at 20%. So there is significant room to up private schooling in the country. I'm not saying it's going to get to 20%, but it just gives you an idea of what the opportunity is. It implies 2 million additional private learners in South Africa. And we know what the public sector education system is doing, deteriorating, former Model C schools as well. And private education also leads to superior academic outcomes. It's the same story in higher education, so tertiary. There have been no public or new public universities built since 2014, but the number of eligible matrics has increased by 30% since that time. So there's a 210,000 shortfall every year of matrics that need to be placed. Now, obviously, not all of them can afford to go to private universities, but if you look at UNISA as an example, there's 400,000 students there. Around 200,000 of them aren't on NSFAS or are paying themselves. So that's an online opportunity that a business that like Advotech and Stadia can take advantage of. We own both of those in the SA Equity Fund. And this opportunity exists, absent any big uptick in economic growth. So Advotech, we think, is a secular grower. I looked at this again yesterday. I was quite actually surprised where it's trading. So, the country's been growing nominal GDP 5.7% over the date. But Advotech's enrollment's been growing at 8.5% per year. The most recent enrollment, they grew 10% learner or growth, which is actually an acceleration. So law of big numbers not really applying. They're bigger, but they're growing at a faster rate. And if you put everything together, we think Advertech can compound earnings at 15% per annum for a number of years. It's trading on 12 times. You also get a 4% dividend yield. So I think in excess of 20% per annum kind of return is what we expect from Advertech. Another opportunity, so this is quite an interesting graph. It's data that's quite hard to come by, but this just shows you what the South African beverage can market has been growing at per annum over the past few years. So there's been 8% volume growth. This is those aluminium beverage cans that you drink beer or soft drinks out of, versus SA economic growth that's 1% odd. It is really a pocket of growth, and there's a couple of it. You've got a booming energy drink market in South Africa. Now, whether that's a good thing or bad thing, I think is debatable, but that's growing at 20% per annum. A lot of the market is still drinking out of beer quarts, glass. Shebeens are wanting to move away from it. It's also heavier and more costly to transport, so suppliers also want to move away from it. So 500 ml beer cans are taking share from that. And then Coca-Cola is finally pivoting back to 500 ml cans again. So if you go to the shops, you'll start seeing 500 ml cans on the shelves again, and that's consumer demand led. So how are we playing this is we've got a stake in Nampak in the SA equity fund. So what I've done here, I haven't given you the exact numbers, but I'm just showing you what the kind of potential opportunity is. I've color-coded things. So the green, I think, that's in the bag. That growth you'll get. The orange is you'll get, but not the orange, the yellow, sorry, you'll get, but to some extent. And then that Zim kind of dark orange, that's, I'm not entirely sure whether they'll get that cash from the Zim government or not, but I've put it in there nonetheless. But essentially, it's a business sitting with a lot of spare capacity. They're bringing an additional line from Angola to South Africa at kind of very low cost, so they can grow into that capacity. Angola is running at 40% odd capacity. When it used to run at 60% capacity, it used to make double the profits that it's making at the moment. And they're one of their largest customers. They are the only player in the market there. One of the three customers is also expanding production at the moment, so that should see some volume growth. And then the DRC's open their border again for export, so that should benefit them as well. So Nampak from here, I think, is quite an exciting opportunity. There's been a bit of a kind of overhang with management changes there. Well, not management changes, but the CEO that they appointed is no longer take over. Phil Roux will stay on for some time. The previous CEO stepped away for personal reasons. Then just in terms of SA equity outlook, so you guys have seen this chart already today. This is really capturing SA Inc. valuations, not the whole index as a whole. We're sitting at around 10 times, which is it's about a 15% discount to history. So the market is very cheap, but what we are lacking is growth. There needs to be some kind of a catalyst, before I think guys will start buying SA Inc. shares again. Or you need to be sitting in businesses with self-help, or you're getting a good yield. These are the top 5 holdings in the SA Equity Fund at the moment. So Prosus Naspers, 15%. FirstRand and Absa are kind of our 2 top picks on the banking side. As I mentioned, banks in general we think offer exceptional value at the moment. We've got a 5% position, so that's that schooling theme. We've got just over 3% in Stadio as well, so 8% bet there. And then African Rainbow Minerals, which I see a couple of the other presenters also had up. We've got a 5% bet over there. And then here's just the very long-term track record. So just a reminder, the early years there up until about 2004, those were stock portfolios or SA, kind of stock portfolios that the business started with. And then since then, it's the track record of the flexible fund. And the flexible fund, I think for additional context, has always been an SA-centric flexible fund. It's only more in recent times where the offshore component has increased. It's around 30% at the moment. But if memory serves me correct, in those earlier years, it used to be around 10, maybe 15% kind of at the peak that was offshore. So these returns have really all been generated in SA. So just to conclude, we do have 25 years of outperformance in the SA market. We think there's structural growth opportunities absent of SA growing. I counted all these up in the fund yesterday or last night. It's about 25% of the fund are in businesses that are completely independent. I'm talking SA Inc. That I think are completely independent of what the SA economy is doing. We think there's scope for SA Inc. businesses to provide superior returns. We do need to see some kind of a catalyst to get growth going. And we're going to continue sticking to playing our own game. And that's it.
Nick, sorry,
Yeah.
very quick question. I just want to check, is there any questions from the audience for Nick? Yeah, got one, yeah.
How's it, Paul?
So it appears that everybody that's presented this morning has made very little of tariffs.
Yeah.
And you say that the answer to all of that is that businesses find alternative markets very quickly.
Yeah.
I think about the motor manufacturing sector in the Eastern Cape.
Yeah.
That's where my thoughts are.
Yeah.
Do you know anything about that? Can you tell us what the outcome's going to be there? Think about all those families.
It's obviously not positive, but I think the overall impact, numbers I've seen is less than 0.5% of GDP kind of impact if what the tariffs could potentially be. I've also seen that, by example, I think BMW exports to the US. Over the past year, that number doubled. I think it's halved year to date. Some of those vehicles are finding their way to Europe. And it seems now Europe is exporting their BMWs to the US. So things are moving around. Net, it's negative, but it's not
Catastrophic.
all shut down, is the point I'm trying to make. Yeah.
Okay, we'll survive.
Just very quickly, and I mentioned it earlier as well, clients are greedy. We all know that. All right. So if you look at SA equity past 12 months, roughly about 26%.
Yeah.
And we've seen Centaur's history, and we know how Centaur work, and I mean, you stood your clients in good stead for a very, very long time. Looking at the past 12 months, what didn't work in your fund, and are you sticking to those companies?
So it's been more like a year to date versus a 12 months. It's been, we have had very little, if any, precious metals. We've had no gold, which has been brutal. Gold isn't something we typically, I copy paste what Scholl said. It's not something that we typically would invest in. I've got no clue where the gold price is going. Platinum sector we would play in. So we've bought Valterra. We had a bit of Northam at the start of the year, but I think gold shares or the index is up 115% year to date. So if you've had no gold, probably 10% drag, which is very difficult to make up elsewhere. So that's been it. But where the gold price is going, I don't know. I hope it doesn't go to 5,000.
Hope it's not a strategy.
No.
Nick, thank you so much. Right.